Assalamualaikum and hello. I bid to Dr. Sabarina and my fellow friends. So today we will present about inventory management. We are from group 4. This is our outline for inventory management. The first one is the processes involved in the inventory management. Firstly, the business entity will purchase the raw material from vendor, and that is the purchasing cycle. The process of inventory begin with the delivered, which is the vendor delivered the raw material inventory to the business entity. After the delivered, the receiving department will receive the raw material from the vendor. This is the process of receiving. And then after receiving, the receiving department will put the raw material in the raw material store. At here, once goods arrive, there must be safeguarded against pilferage or unauthorized use. It is to make sure the raw material is safe. The next process is manufacturing. It is production of goods, which is the goods can be produced by using a job order system, a process cost system, or combination of both of them. The last one is transfer to finished goods store. When goods are completed, the good will be transferred to finished goods store. And when the customer want to buy the goods, the business entity will sell it to the customer, and that is the revenue processes. Okay, then we move on to the source document. There are a variety of source documents that involve in the inventory management. The first one is production schedule. It will determine the quantity of goods needed and the time at which to meet production schedule, and give the auditor information on the planning level of the operating activity. The next one is receiving report. It is used to update the entity's perpetual inventory record. The next one is material requisition. This document is used to manufacturing company to track material during the production process. The next document is inventory master file. This document contains all the important information related to the entity inventory, include perpetual inventory record. For the next document, it is production data information. This document is the transfer of good and related cost accumulation at each stage of production should be reported. The next document is cost accumulation and variance report. For cost accumulation report, this document summarizes the various costs charged to department and product. For variance report, present the result of inventory processing between actual cost versus budgeted cost. And the next is inventory status report. This document shows the type of amount of product on hand and also determine the status of good in process. The last one is shipping order. This document is a part of revenue process. A copy document used to remove good from the entity perpetual inventory record. For next questions, we move on to the journal entries and account involved in inventory management. For the account involved in inventory management, the first transaction is purchase of inventory. The account involved is cash, account payable, and raw material inventory. The next transaction is moving raw material to the line of production. The account involved is raw material inventory and work in process inventory. The next one is recognize finished goods inventory. The account involved is work in process inventory and finished good inventory. The last transaction is finished goods sold to customer. The account involved is cost of goods sold and finished goods inventory. For journal entry, the first journal is to recognize purchase of raw material. In here, we debit raw material inventory, and then we credit account payable when we buy in on account, or we credit in cash when we buy it on cash. And then moving raw material to the line on production. In here, we debit work in process inventory, and then we credit raw material inventory, which is in here we manufactured the product. And The next one is recognize finished good inventory. We debit finished good inventory and we credit work in process, which means the goods are already completed. The next is finished goods sold. In here, where the customer buy the goods from the business entity, so we debit account receivable and we credit sale. And the last one is record finished good decrease. So we debit cost of goods sold and we credit finished good inventory.
Hi, I am Nur Fatana. Now I will explain about flow chart of inventory management process. Okay, for the flow chart, we start with production management departments. We prepare production schedule. Production schedule is normally prepared periodically based on the expected demand for the inventory product. And then we go to purchasing requisitions. In the inventory department, for the revenue process, there are shipping order and transfer goods to the shipping departments. And for the purchasing process, we have receiving reports and inputs, go to input programs and general ledger programs, and then general ledger. In the IT department, for the payroll cycle, we'll have inventory master file, purchase order file, labor distribution file. All the I file will go to inventory program and inventory status report. And then inventory master file and general ledger master file will transfer to general ledger programs and general ledger to the general accounting. Okay, next we will proceed to internal control. Okay, for internal control for inventory, in the console framework, we using control activity. First, tracking. Maintaining a catalog of exactly what a business has and where it is. Most businesses today rely on electronic inventory by using barcode and RFID tag to keep close track of item. Our inventory location should be numbers and inventory item identified with those numbers. Second, security. Keep their inventory in a central location. Is that this allow them to also keep it secured. Add measures such as law and security codes can help ensure that only certain trusted persons have access to inventory. Or delivery from supplier require a count before they go into the inventory, so that difference between the delivery and purchase order are immediately remedied. Okay, next review. Important to the company maintain an up-to-date inventory. If the supplies and items are allowed to sit on the shelf for too long, it will lose the value. It is better to sell some items at the loss than allow them to sit any longer in the inventory. Next, audits. Project audits of bill of material, negative balance in the inventory, and scrap tracking with offset inventory locations error, misallocations for raw material, over purchasing, and the overstatement of material in the inventory. For the example, if the material are taken from the one warehouse, but material record as the taken from the second warehouse, the second warehouse may show a negative inventory balance. Okay, now I will explain about risk area in the inventory management. Okay, there are 5 risks involved. First, input shortage. A lack of input such as material and parts or cost of downtime for the operational process such as a production line. Second, exist inventory. Result from the marketing issue, sale forecast and the inventory planning failure is often need to be discounted to sale. Third, value loss. Instead of a product, part or material sit on the shelf, it may lose the value. Value can fail quickly due to a new product launched by the competitor. And fourth, inherent risk. A control failure that the result in an incorrect inventory count. For the example, a firm found that it has $1 million in the missing inventory when it performed a year audit. And lastly, supply shortfall. A product generate more demand than the expected is quite sold out. There is represent a loss review opportunity is the chance for the sale limited.
Hi, I'm Nur Hashima. Okay, now we go to important exceptions in inventory management and relevant audit procedures. First important management exception is occurrence. Auditor's main concern is that all recorded inventories exist. So therefore, all the inventory are recorded for receipt or for use and not be stolen. So that is the main concern for the auditors for occurrence. Next is completeness. So auditors want all the recording inventory that has been received and goods held on consignment by other parties are included in inventory, and goods held on consignment for others are excluded from the inventory. Okay, next is accuracy. So the amount that recorded in those transactions have been recorded appropriately and accurately. Lastly is ownership. Is the inventory is wholly owned by the company. So that's the important management assertion. So relevant audit procedures. First is test of controls. Auditors test the operating effectiveness of control in preventing or detecting and correcting material misstatement at the relevant assertion level. So in test of control that auditors can do is first inspection of records or document. Auditors select a sample or receiving document for inventory, receive and ensure that they are supported by receiving document. Next is physical control. Auditors check the inventories and do calculation before transmit to customer. Second is risk assessment procedures. So auditors use it to obtain an understanding of the entity and its environment business. For example, inquiry of management or others. Auditor might also inquiry of recognition or assessing the value of inventory if they do not know how to value the inventory. Last is substantive analytical procedures. Is the auditors obtaining assurance on the valuation assertion of inventory. So auditors might do observing physical inventory. Auditor perform test count and records a sample of count in the working paper to evaluate the accuracy and completeness of entities' inventory compilation. So now we move to inventory case. Okay, the case is about late in December 2005, your public accounting firm accepted an audit engagement at Fine Jewelers Incorporated, a corporation that maintains a diamond wholesale store in New York City and retail jewels stores in several eastern cities. A buyer employed by the wholesale store purchases diamonds in the New York diamond market. The wholesale store carries a substantial inventory of diamonds that are set in rings and in other quality jewels based on orders from the retail stores and from independent customers. The corporation values inventory by the specific identification cost method required. Assume you are satisfied that Fine Jewels Incorporation has no jewelry left by customers for repair or for sale on consignment, and that no inventory owned by the corporation is in the possession of outsiders. So first question is discuss problem the auditor should anticipate confronting on the physical inventory as a result of the A. Different location of the inventories. The auditor should control all physical inventories till it has been calculated to be certain that all gems are not transmitted from one point to another point and encompassed in physical inventory more than one time. Gems are simply transferable and are not readily different from other gems. Therefore, if the auditors control all of the physical inventories throughout the totaling of the physical inventory, they would be unclear about the gems and jewelry being transferred from one store to another store without their understanding. B. Types of inventory. The kind of inventory is such that auditors are not capable without proper spatial training to recognize or assess the value of merchandise. Though they can calculate the gems on hand, they cannot show whether the calculated valued gems or closely valueless imitation. It is hence essential that the auditors appeal to the client to involve the facilities of a professional who is capable to recognize and assess the value of gems.
Second is explain how your audit program for this inventory will differ from the use for the most other inventory. The first one is test high value item. This value of diamond are of unusual high value. The auditor will likely spend extra time counting them in inventory and ensure that they are evaluated correctly, and also tracing them into the valuation report that carry forward into the inventory balance in the general ledger. The company has specified identification cost method, therefore the auditor should review and check the identification cost. Next is test inventory in transit. Inventory in transit from one storage location, which is from New York City, to another at the time of the physical count. Auditor tests for this by reviewing transfer documentation. The last one is observe the physical inventory count. The auditor will discuss the counting procedure with the management for make it comfortable to observe count as they are being done. Test count some of the inventory themselves and trace their count to the amount recorded by the company counter. And also verify that all inventory count tags were accounted for. For 2B, draft procedure for the audit of corporation diamond and diamond inventory and identifying any step that you would apply only to the retail store or to the wholesale store. Firstly, the auditor need to make classification on the diamond jewelry inventory to ensure whether it is properly classified as raw material, which is diamond as the whole store, work in process or finished good, which is ring and other quality jewelry. This step can be applied only for the wholesale store. Secondly, perform test count and record a sample of count in the working paper by the physical counting on the diamond. This step can be applied for retail store because they want to ensure the quantity and price of the diamond is same as with what they ordered. It is also to ensure the diamond does not double counted while the physical counting test is done. Thus, the accuracy and the completeness of the company inventory compilation can be evaluated. The last one is the auditor does reperform the method for valuation of inventory and review the performance so that take only specific costs that incurred in the valuation of inventory. This step can be applied for wholesale store. Due to large inventory that involved in this store and deal with expensive goods, the company made a good choice to use specific identification cost method for their inventory.
Okay, for the third question, assume that a shipment of diamond ring was in transit by messenger from the wholesaler store to a retail store on the inventory dates. What additional audit step will you take to certify yourself as the gems it was in transit from the wholesaler store on the inventory dates? Okay, the shipments of diamond rings was in transit by a messenger from the wholesaler store to a retail store on the inventory dates. As an audit, freight cost analysis to add to determine the shipping cost or how much it costs to get a diamond from a wholesaler store to a retail store. Next, tracking the times between the dates of the shipments and the date of receipt. The documentations account for any units of inventory that are in transit and also in case anything is lost or damaged in transit. Okay, lastly, match invoice to the shipping log. The audit should verify that invoice match the number of items and cost of inventory shipped from the wholesaler store. Audit verify the right amount was charged to the retail store on the inventory date. Okay, that's all for us. Thank you.